If you are a business owner, you've probably heard someone say that you should be an S Corp. Should you? My name is Joseph Ritter with Somerset Tax Partners. Thank you for joining this webinar, and we're going to try to answer that question today. I am a enrolled agent and certified financial planner, and I have a number of business clients, and I always enjoy helping small business owners, especially when it comes to tax matters. I usually take for granted that you are very good at what you do, but when it comes to taxes, I would not expect you to know everything that there is to know. So I enjoy coming alongside, learning about who you are, what it is that you're doing, how you're leaving your mark on the world, and then how I can help you with your taxes. As we go through this webinar, you'll probably have some questions. I would ask that maybe you think about holding your question until we're done with this webinar. You can always post a comment, and I will do my best to answer it. But as we go along, I do hope that I will be answering most of your questions. If you're like me and you have a question, you may end up forgetting it. So feel free to jot it down, and then feel free to also take notes and see if I answered it. If I did not answer your question, then post a comment. With that, let's dive in. Should you be an S Corp? I don't know. Should you be? There are differences in how businesses are taxed. There are three main tax structures that we're going to be looking at today. And the first one is a Schedule C filer, Schedule C on your Form 1040, just on your personal return. This is the most simple and easy to follow method. Probably requires the least amount of bookwork, the least amount of tax knowledge. There's really no extra hoops to jump through. But there is a tax to pay on the net profit, and that's what many people like to avoid with the S Corp. The S Corp and the C Corp are options, no matter whether you have no structure or if you have any structure. They are options for a sole proprietor, a single member limited liability company, or a multi-member company, and a corporation. So you can choose C Corp or S Corp no matter what kind of structure you are, or if you have no structure, but there may be some paperwork to go through. If you are a sole proprietor, your default is Schedule C on the 1040. If you are a single member LLC, that is the same default, Schedule C on the 1040. A multi-member, by default, is a partnership. We're not going to talk about that today. That's a more complex structure, and I would caution against using that. You can choose to be taxed as a corporation, and then in there, once you choose that, you can be taxed as a C Corp or S Corp, and then a corporation is always taxed as either a C Corp or S Corp. The default is a C Corp, and it's changeable. So all these are flexible. Everything is changeable, and we're going to talk about whether or not you should do that. Sometimes I've heard my colleagues say it's always better to be an S Corp if you have over a certain amount of business revenue, and I've heard that magic number to be anywhere from $30,000 all the way up to $60,000 or even $80,000. I don't follow common wisdom. Maybe that's why you're watching this webinar. It would probably help if we look at some scenarios. So let's do that. So we're going to start with a Schedule C. Again, that is a sole proprietor or a single member LLC. Those are your choices. We're going to use gross income of $80,000. Now, as we go along, I'm going to change the term for this, and we'll call it net profit. So by gross income, what I mean here is after all other expenses, not counting your payroll as the business owner, not counting anything you take out of the business, but we have already subtracted out here things like rent, mileage, whatever, cell phone, any other expenses that you have for running your business. All that has been taken out. So we're only going to be looking at the net profit, and then as we go along to look at the amounts that you take out of the company as payroll. So $80,000 is our number. Self-employment taxes come out of net profit on a Schedule C. You can deduct 1/2 of that. Then you have the standard deduction, and that brings taxable income. So we have both of these on the married filing jointly and the married filing separately. Except for the standard deduction, they are the same numbers. Once we get to taxable income, the first line there is actually a misnomer because our tax is not calculated on that. We actually use taxable income to calculate what's called the qualified business income deduction. This is something new in 2017 with the Tax Cuts and Jobs Act. This is a 20% deduction against business income, but it is based on your taxable income. So we take the taxable income before subtracting it, and then we net those two together to get to taxable income. This is $39,959 for the married filing jointly, or $49,719 for a single filer. Now, based on this number, you have your regular income tax. So on the total tax figure, we have both the self-employment tax and we also have your regular income tax. Self-employment tax is 15.2% of your net profit. So here it is based off of the $80,000 figure, 15.2%. And then on a taxable income of $39,000, it's going to be roughly $4,410. In the balance of that figure, the total tax there on the bottom, $15,699, that includes self-employment tax. So that is the Schedule C filer. Now that we have that, it's a baseline for looking at the S Corp. Most small businesses would start here on Schedule C and then graduate into something a little bit more complex. Okay, so now we are looking at the differences between the S Corp and the Schedule C. And I want to explain some of these numbers here so that you can follow along and see how I'm getting to my bottom line numbers. First, we'll start with the business income. This is our net profit. Again, we're using the same figure that we did from Schedule C. We're assuming that all other expenses have already been taken out of this, and we're down to working with the net profit, figuring out what that is. You'll notice here that business tax is 0. That is because the S Corp, even though it is a separate entity and files its own tax return, it does not pay tax at the company level. The net profit passes through to the shareholder, and all of the business items are then taxed at the shareholder level. It's called a pass-through tax system, and some people really like this. So we're working with here, you also see we're adding some rows. This one is for salary of $45,000. In a S Corp, when the shareholder provides services, there must be a reasonable salary taken by the shareholder for those services. Now, there are a number of different scenarios. We're not going to go into detail on all of these, Basically, what this means is, what would you be getting paid if you were doing the same job for a company that you did not own? So if you are the manager of, let's say, a plumbing company, what would that manager get paid? And that then would be your starting point. You're looking at what other people in similar jobs are getting paid if they're working for a different company, if they don't own it. And that's a very good starting point. The reasonable salary is required under the tax code, and that is sometimes where folks get tripped up on the S Corp because they don't take a reasonable salary. The salary must be reasonable. Reasonable as a test under the tax code. If you were to be audited, this is going to be one of the elements that they look at, and probably look at more closely than others. So you want to be sure that your salary can be justified and that it is reasonable within a similar environment at another company that's doing something similar to you. There are some lines of business when the shareholder does not necessarily have to take a reasonable salary for all of the revenue. One example of this is a realtor. A realtor or a real estate broker may choose to have a S Corp to handle everything. Real estate sales commissions are not included when you are determining what is a reasonable salary. So you can pass those through without having to run a reasonable salary test on them. Then what is the reasonable salary calculated on in that case? It would be the services rendered to the company. So if the broker is also obligated to manage the office, then it would be the managerial services that we would be talking about. What is reasonable would be based on only those services, and we would carve out the commissions. So there may be other services like those when they are normally not treated as payroll. You can get by with using a 1099 as a contractor. Realtors and brokers are certainly some. There may be other lines of work. Reasonable salary then only factors in the services to the company, which would be management related. If you are a sole shareholder and you are doing most of the work, and you are, just go back to the plumbing company, you're running a company like that, you are going to be a employee with payroll for pretty much everything that you do. It's only if there's a recognized exemption or standard that you can get away with not running funds through your payroll. So most people are going to be under the reasonable salary requirement for pretty much everything that they do in their company. Okay, so let's look at the top here. What goes on to your personal 1040, and we're starting with a number of 76,288. And you're probably wondering, where am I getting this number from? Well, I'm assuming here that we're taking a reasonable salary. Now, let me just talk about the numbers that I have on this spreadsheet. Again, we are working with a net profit of $80,000. That means we've taken all other expenses out of this already. Those expenses are probably in the range of, we'll call it 35%. So we have revenue of about $125,000, and I'm using another 35% or so for the reasonable salary, rounded it to $45,000. So in the income of $76,288 is your salary of $45,000. So we take that out of the 80. And then the business also deducts 1/2 of the payroll taxes. So the business pays and also deducts 1/2 of the payroll tax. The employee pays the other half, and the business cannot deduct those. The business may be writing a check for those because they've held it from the employee's pay, but the business actually cannot deduct that share. So 76,288 recognizes that there are payroll expenses that have been taken out of the business net profit. So this is where we land. Then we take out the standard deduction. We arrive at the taxable income, and then we have the qualified business income deduction. Now you notice that it's smaller than what we did under the Schedule C. And the reason for that is that your business net profit, the amount on which this deduction is calculated, is $80,000 minus $45,000 in the payroll minus 1/2 of the payroll tax, and that's your net business profit, and that's the number that we will be using for the qualified business income deduction. That brings a taxable income for a married filing jointly of $45,630, or a single filer of $57,830, and then you can see what the total tax is here. So right away, the first thing you'll notice is that, oh my goodness, it's so much cheaper to be an S-Corp than it is to file Schedule C. I mean, for a married filing jointly, we're talking about in the ballpark of $3,500, and you say, wow, Joe, why are you doing this webinar and questioning the common wisdom? Well, let's demonstrate something. So you have a net profit here of $80,000, and you think to yourself, well, why am I only paying myself $45,000? Maybe I should pay myself, I don't know, let's say $70,000. So we bump this up to $70,000, and now what we have here is we have more tax to pay. Our qualified business income deduction goes down to $845. So where are we now? Our payroll tax goes up because our salary went up. The business deducts more of the payroll tax. The business deducts the $70,000 salary. So the business net profit actually goes down to $4,225. That's how we end up with a much smaller qualified business income deduction. And then we end up with a tax that is almost $800 more than the Schedule C. How in the world does this happen? What I'm showing you is that filing as an S-Corp does not guarantee that you will have less tax, because it is possible that you will end up paying more tax, or at best have no difference in your tax. This is where folks get tripped up. Sometimes I have very difficult conversations with my clients when they say, well, wait a minute, I paid a tax something like that last year when I was a Schedule C. Well, how comes it's not so much lower? I was told I would be paying a lot less tax as an S-Corp. And I pull out my spreadsheet and I run through the numbers and I show them something like this, and I come up with sometimes I come up with a difference that is basically nothing. And then I have to ask them the question, why would you go through all the trouble of an S-Corp if it doesn't yield a big benefit? So those are questions that we have to ask. But you can see that it is possible with good tax planning, with sound tax planning, to pay less tax with the S-Corp. As long as you are within the reasonable salary range, it is quite possible to pay less tax than if you were a Schedule C. But if you're not careful, it's possible to pay more than as a Schedule C filer. And that's the point of this webinar. This is what I wanted to show you in this webinar with the numbers, because the numbers don't lie, that it is not always better to be an S-Corp, and it does not guarantee a tax savings. It's possible, but there's no guarantee. Now let's talk about this reasonable salary. Let's revisit this for just a minute. Do you have to take a reasonable salary for all of the net profit? And the answer is no. So if we go back to the $45,000 salary scenario, after payroll taxes, you have roughly $30,000, we'll just call it there, make it a round number, of cash left over in the business that is your net profit, and you can do with that whatever you would like. This is where some tax planning comes into play. You could use that to make a year-end purchase that may be deductible. You could use this cash and leave it in the business because you think you might need it next year. So there's some business planning involved there. Some business owners also like to take a mix of payroll and a draw, a shareholder draw, which we will call a dividend. Just like if you owned a stock in a publicly traded company that pays a dividend, the shareholders can get a portion of the net profit, and that's called a dividend. Now, let's talk about the dividend. In the S-Corp, the dividend does not generate another tax. The corporation, the S-Corp, does not deduct the dividend. In other words, it does not affect the net profit, but the shareholder does not have to pay extra tax on the dividend. So once you've paid this tax, then there's nothing further for you to do. You can freely take that $30,000 out, and there's no extra tax consequence for doing so. But the question is, should you? Should you take a large dividend out of the business? Something to look at in the S-Corp is that you have what is called basis. Now, you don't necessarily have to deal with this as a tax issue when you're filing a Schedule C, but you do need to be aware of it when you get into the S-Corp. What is basis? The simplest way to think about basis is if you purchase a home, what you pay for that is your basis. Over time, your basis may change. You may put a new roof on, you may add new flooring, or you may renovate, you may upgrade your kitchen or add a room on. All those things can add to your basis. And then when you sell that home, the sale proceeds can be reduced by your basis, the adjusted basis over time, to arrive at any possible capital gain or loss. You have the same concept with the S-Corp. There's a basis here. Your starting point is what you put into the business, and then your basis changes over time. Every year, when you come down to the end of the year, your net profit is added to your basis. So what happens if you take a draw, if you take a dividend? Well, that's going to take away from your basis. Money that you take out of the business goes against your basis. So it is quite possible to end up going below your basis. And that could be a bad thing, because if you have very close to zero basis, which is not something I recommend in an S-Corp, you really should have a good, healthy basis, then when you do take money out as a dividend, you may go below your basis. And when you do that, the tax code says that you are taking money out as capital gain. Your basis is what you have in the business. And once you have taken that out, like selling your home, you're taking out capital proceeds now. So the business is worth, in this case, you're adding $30,000 to your basis. So the business is worth another $30,000. If you started with a zero basis and you added 30,000 to it, but then you take a draw of 40,000, you've gone 10,000 below your basis, and now you have a $10,000 capital gain. And this can create a tax headache on your personal 1040. So this is something to be aware of. I do recommend taking money out as a shareholder through payroll and being careful with dividends. Now, some people do like to minimize payroll and then take more dividends because they want to avoid payroll taxes, and that's a no-no because you can get messed up both on your basis with capital gain, and if you are audited, the IRS can come looking over your shoulder and look at your reasonable salary, and if it's a problem, they could very well adjust it and then assess past due payroll taxes on you, and that could be a big ouch. All right, now let's look at the C Corp. We have the same numbers here. The C Corp, we're starting with the net profit of $80,000, and just to keep our scenarios accurate, we're going to assume that you have taken out a $45,000 salary, just like you would have if you had the S Corp. And you can see here what your tax is. And married filing jointly, the tax on your 1040 is $2,087. Now we've added a new number here. In the business tax, there is actually a number. It's not zero. And what this means is that the C Corp is taxed at the business level. There's a flat 21% tax on the business net profit, and our net profit here is $80,000 minus your salary of $45,000 minus half of the payroll taxes. So that gets us to our tax at the business level. We add in the payroll tax, and then you can see our total tax here of $15,767 for married filing jointly, that it's very close to the Schedule C. I would argue that this is within range of error. I mean, we're only talking about $68 here, so that's not a lot of movement. I would call this a wash. On a single or married filing separately, it's actually just a little bit cheaper to have this set up in a C Corp. And one of the reasons is that you are achieving a better, a more favorable tax rate in the C Corp. Now, even though I say that, at this level of revenue, the C Corp is probably not your most favorable tax structure to choose. Where this would be more favorable is when, as a shareholder, your personal tax bracket is much higher. So here we're talking about a tax bracket in the 10 to maybe 15% range. If you had $500,000 or $1 million of revenue in your company and you were drawing a pretty hefty salary, then the C Corp would make a whole lot more sense because it's still a flat 21%, where your tax bracket could be almost double that. So there are times when the C Corp makes a lot of sense. In a case like this, I would say between the Schedule C and the C Corp, you are much more flexible and you'll probably end up being more comfortable as a Schedule C. Now, let's talk about some of the nuances of the C Corp, just so that we're on the same page here. Money coming out of either the S Corp or the C Corp can create a tax impact on your personal taxes. In a C Corp, when you take money out, it's either treated as a dividend or treated as payroll, just like we talked about with the S Corp. You don't necessarily have the same basis concerns in the C Corp. However, if you take a dividend out of the C Corp, here's what happens. Just like with the S Corp, the dividend is not deducted against the net profit. So you have here a net profit of $31,288. If you took $30,000 of a dividend You're not going to reduce your net profit. That means the business tax remains the same. Where you do have a problem in the C Corp is that the dividend is now taxable on your 1040, unlike with the S Corp. So if you took a $30,000 dividend out of the C Corp, now you're adding $30,000 to your taxable income, and instead of being taxed on $20,600 for a married filing jointly, we're talking about a $50,000 tax. Your tax goes up quite a bit, plus you're paying the business tax, plus you're paying the payroll, and yeah, you can see that number's going to go pretty high. So one of the things to remember when you have different tax structures like an S Corp or a C Corp, it is a separate entity, and it must be respected as a separate entity. There are certain rules to follow. If you do not respect it as a separate entity, if you treat the business bank account as if it is your own, you could very much run into trouble. There have been cases when business owners did not respect their entity and have paid a very dear price for it. So one of the reasons that I bring this up is that as a separate entity, you have to treat it as if it's not your own. And anything coming out of the company is going to be taxed, especially in a C Corp. That's something very important to bear in mind as we're going through these different scenarios. Again, you might be able to save a little bit of money with the C Corp, but you're going to save a lot more if you had a lot more revenue. So here we are looking at the differences between the Schedule C, the S Corp, and the C Corp, and I showed you right away that it is possible to save quite a bit of money in the S Corp, but I also showed you that it's possible to end up being a wash across all three, or paying even more tax in the S Corp than if you were a Schedule C. So now you're probably wondering, should I be an S Corp? I don't know. Should you be? I've shown you here that there are not very many differences between the Schedule C, if you qualify, and the S Corp or the C Corp. And if you are a single owner in your business, you could choose any of those three as your tax structure. It's possible to save money, but you need to do good tax planning. You probably need to bring in a tax pro to help you achieve those savings. So I showed you here that on roughly $125,000 of revenue, as a married filing jointly, you could achieve possibly a savings of about $3,500 in tax. That's certainly worthwhile. That's a decent amount of money. Is that something you would want to do? Is it worth paying someone like a tax pro to guide you through the planning to get to that point? Now, here's something to also bear in mind. When you go to the S Corp or the C Corp and you have payroll, you're going to have quarterly payroll filings. And if you hire someone to do that, there's going to be a cost there. As separate entities from you, the shareholder, the S Corp and the C Corp also require their own business returns. So you have a business tax return and a personal return, and that's going to add to the cost. You could very easily, as a business owner, end up paying $1,000 to $1,500 in tax prep fees each year to save $3,500. So should you be an S Corp? Is it worth going through all that? I took on a new client a while back, and I was able to show him that in his case, the difference between a Schedule C, the S Corp, and the C Corp was very, very minor. I mean, we were talking about maybe $200, maybe. And I said to him, is it worth jumping through all these hoops to maintain the S Corp? And he said to me, I don't know what happened, because up and down I was told that I would save money as an S Corp, and you're showing me here that I'm not. And I just demonstrated to you that it is possible to pay more or to have it be a wash between the Schedule C and the S Corp. So without good tax planning, maybe there is no difference. So in a case like this, when I work with my clients, I encourage them, and I would also encourage you to think about non-tax reasons that you would want to change your tax structure. Rather than look at this as a tax-driven motive, let's take the taxes off the table. And let's say that instead of being driven by the taxes, we're going to be driven by non-tax issues. What is a non-tax issue that may drive you to choose a different entity and be taxed in a different way? Liability may be a non-tax issue. Liability in the sense that as a Schedule C filer, if you have no formal company structure, you are liable. There is no barrier. There is no separate entity in which to shelter or shield yourself from liability. That's one of the nice things about limited liability companies and the corporation, that they can actually keep all of the liability inside of the company. That way you as the shareholder do not need to feel the full impact of that. Again, you must take great care when you have a company, because there's something called piercing the corporate veil, and lawyers and courts can do that if you fail to respect the company as a separate entity from you. If you are using the business bank funds as your own personal kitty, if you're not holding meetings and you're not documenting them in minutes, if you are running the company as if it is your own personal space, then there may be a piercing of the corporate veil. And in that case, liability can go through the company to you as the shareholder. So there is a risk there that you can lose the benefits of a company structure. So that's one non-tax concept to be thinking about. There may be others. I'm not going to try to go through every single scenario. My point is this: when I can show you that there's very little difference between the Schedule C, the S Corp, and the C Corp, why would you want to do it? And maybe it is better for you to be an S Corp or a C Corp, and maybe there are non-tax reasons that you would do it. And oh, by the way, there may also be some tax benefits if you do it right. Liability. Let's just address that a little bit further. I recently got wind of a new product that you may want to think about in your business. I think it was invented just last week. It's called, insurance. And it's this very unique product that you can purchase a policy, you can pay a company money, and if there's a claim, the company handles everything for you. That's really unique. Now, I'm kidding. Insurance has been around for many, many years, but how many business owners actually use it? How many business owners actually have a policy in place? I talked with a new client a while back that told me they had no insurance and they were filing as a Schedule C with no company structure. And I said, liability is a big issue for you. Maybe you might want to think about getting some kind of a company structure as a start, and then insurance as a backstop. On that note, let me just tell you a story about a auto repair shop down the street from me, from my office. Now, this is not my client. I really know nothing about his tax structure or what kind of products he owned. But it was a very good case that I think all business owners should sit up and take notice. So this fella had a shop on the corner, and during the night, a car went speeding down the road, went off the road, and actually drove through his building, and of course put a gaping hole in the building. The building was a total loss. So right there, he lost the value of the property. He lost his business because with a building that is a total loss, he's not able to run his business anymore. And there was actually a customer's car on the lift in the shop that was now hanging off the lift after the crash. So you have three different possible claims there. You have the property loss, that's a big deal. If he has a mortgage on the property, you want insurance in the background to pay off the mortgage. You also want to have business insurance, which can help you have another stream of revenue when your business cannot function. Such as in this case, the man could not go back into his shop. The man could not earn a living anymore. Business insurance can help with that. And business insurance can also help you with the expenses of starting up a new location. And of course, property insurance, in a case like this, when it's deemed a total loss, can help you replace the property. And then there's the issue of the customer's car. Now, I'm not going to get into whether or not, in this case, the customer was liable or the business owner. But let's just say that the business owner is liable because the car was in his shop on his lift and the car was damaged. So there's damage to the customer car, and who's going to pay for that? When you add up all these possible claims here, you realize that very likely the driver who caused all this, his policy is going to be maxed out before all of these claims are paid. So insurance by the business owner can help to cover those gaps. Obviously, there's going to be lawsuits, litigation is going to follow. The driver's insurance is going to pay out the maximum. And then from there, if the business owner has insurance, then it's a very good backstop and safeguard for the business owner, so that he is not put in a place where he personally has to go bankrupt. These are some non-tax issues to be thinking about. What kind of a company structure should I have? Insurance is a good product to have. I don't sell insurance, so I'm not here trying to sell it to you. But I will just say this: whether you have a company structure or not, you should have insurance. So we're back to what are some non-tax reasons that you should have a different company structure or have a different tax structure. What other non-tax motives can you think of that may drive you to change? The sky's the limit on that question. Now, as we close this webinar, I just want to remind you that if you do have questions, feel free to post them. I will respond to them just as soon as possible. And hopefully this webinar did answer some of your questions already, did give you some things to be thinking about. One of the things also in this is if you change your tax structure to a S Corp or a C Corp, you're going to end up keeping much better books. So you might have to switch to QuickBooks if you've not been using them now, or you might need to hire someone to keep your books. So that's also something to be thinking about. So this is the end of our webinar. Thank you for joining us, and I look forward to speaking with you. If you would like to reach us directly to have a question answered, you can call my office at 1-866-862-2220, or send me a message at joe@somersettaxpartners.com, or find us on the web, somersettaxpartners.com. Also, find us on Facebook and we'd be happy to chat with you there as well. Thank you for joining us today.